Good day, everyone. This is Bob Keebler, and I've been asked to walk you through some of the programs that are out on Lineberg Information Services to help us analyze secure act decisions. Now, what we're going to start with is just a very straightforward calculator, life expectancy versus a 10-year rule. It may be appropriate to think about you have a client, you're doing estate planning for them, and they say to you, do we do a special trust for our child that's disabled and try to qualify as an eligible beneficiary? Does it pay to do that, to use the life expectancy rules versus just the normal 10-year rule? Let's explore how you would figure that out. Let's say the child is 35 years old. The IRA, the mom's IRA, is $500,000. We'll use a pre-tax rate of return of 7% and an after-tax rate of return on the outside account side of 5%. Then we'll talk about the average income tax rate during life expectancy. We'll run with a 25% during life expectancy between state and federal. And during the 10-year rule, we'll go with a 30% life expectancy or 30% tax rate. And we'll take the distributions from the IRA at the beginning of the period, and we will do amortization to spread out that income. So what you'd see here, if you look at the chart, what you're very quickly going to see, and you can show to that client, that they're way better off leaving the money to an eligible beneficiary trust rather than to the child in a designated beneficiary trust where they would just have the 10-year rule. So this is very important. What we want to be laser focused on is, does it pay to take the extra effort to design a specially drafted disability trust so you can rise to the level of an eligible designated beneficiary trust, allowing you to use life expectancy versus a 10-year rule? So when you're working with this, that's what you can see. Now, here's another thing we could look at. Just look at these lines, and now instead of amortizing it, let's say we waited to the end and just took a lump sum out, but the tax rate, if you did that, jumped from 30% to 40%. Now, the other scenario, the life expectancy scenario, would be exactly the same. Now you can see that the life expectancy wealth transfer after a period of 40 years, that's by the time this child who's now 35 is 75, if they were disabled, that factor is, you've increased the wealth transfer by over $1.5 million. So you can see it's nice to be able to show these things to our clients. Now, if we look at, we have the 10-year math there. We have the life expectancy math. You can share all this with clients that might be interested. Now, a major question we're all going to encounter is whether or not we should convert over to a Roth IRA. Now, part of the tough thing about developing a program is you have to make it simple enough for everyone to use and everyone understand it, but yet have enough substance to it so it gives you a good result. Let's assume the IRA owner is age 60, and she's a retired dentist. She has $1 million in her account, and she has a taxable account balance of $400,000. And she converts the entire $1 million. Now, you'd probably never go this far, but it's just a good example. And we'll use that 5 and 7 again for our rates. And the income tax rate at the conversion year, let's just assume, would be 35%. We'll make it 37%. And at the withdrawal rate after sunset would be also 37%. We'll make it very straightforward. The question becomes, does it pay to do a Roth conversion? And if you look at this, what you're going to see here is on the Roth side, in the first 10 years, there's very little difference. But then once we get a little bit further out and we start enjoying the benefits of not having to take RMDs, we put ourselves in an even better position. It starts to pull away. Now, you can run these. You can run all kinds of projections with this. If you wanted to say, hey, wait a minute, no one would ever do a large conversion like that, you might only do a $200,000 conversion, bringing down your tax rate on average from 35 to say 32%. And does that make more sense? And of course it does, because you're going to start to see an even greater differential. Okay, you'll start to see an even greater differential over time. So these are important things to look at. So that's the Roth. I have this all laid out for you. The biggest place you're going to see is when you have, for example, someone that does a $100,000 conversion, paying tax, let's say at 22%. This is a very intuitive calculator, the way the programmers put it together for us. I kind of did the architecture, but I mean, this was programmed. And now we're seeing, you can see over time how this is going to work. You're going to end up with an even better situation. So over time, you're going to see that Roth grow and grow. And at the end of the day, there's even a greater wealth transfer. So these are all really good things for us to look at. We do give you the detail here, and along with a little explanation of what's really going on. In both cases, there's not much of a difference up front. It's later where the difference comes into play, okay? And we have to pick what would be the terminal tax rate. The terminal tax rate is nothing more than the rate you would pay at the end in the withdrawal years. So when you take the money out, what will be the rate you'll pay? Again, now I want to make one more change to show you a little bit more how this is dramatic. If you had $100,000 in the IRA and only $40,000 in the outside account, you'd be able to show this. One very important thing is when you're running these projections, you want to isolate just what you're converting. You don't want to mix it in. You don't want to do a $50,000 conversion on a $5 million IRA because the difference is meaningless. You'd want to isolate that out like I have here. So that's a quick synopsis on the Roth side. Again, these little tabs show you basically what each input is designed to do. Now, there's a concept called IRA relocation. This is basically what we do when we're looking at buying insurance. So let's say you had a person who was exactly 60 years old. They have an IRA balance of $1 million. The growth rate on the IRA is 7%. The after-tax growth rate is 5%. The tax rate on distributions coming out, we can still manage that. A married couple, we can still manage that at 24%. Let's assume that we have an annual insurance premium of $25,000. And we're going to not have any changes in that premium. The insurance death benefit is an $800,000 second to die policy. And we increase that each year by about $7,000. What did we just learn? Oops. Maybe, I'm sorry, I shouldn't have done that like that. Okay, what we would see in this case is with the right policy design, you would come out ahead. Now, this would be a very attractive scenario. Most of the time, it's going to look something more like this. This was an exceptional design for a client, but most of the time, what you're going to have is those lines are going to be much, much closer together. Let me demonstrate this for you. And you're going to end up way out here. You'll be able to see kind of where the break-even point is. This is a very simple but valuable tool. The way to make the insurance work, the critical part of this, is you have to maximize the ROI on the policy. And that means being willing to go with a little bit less insurance up front. Let me change this. I'll change this to $600,000 up front. And we'll just increase that by 10% a year. Well, that's probably a little bit too much, maybe. Let's look at 6% a year. And now again, what you're going to see is the insurance, it starts low and grows to a higher number over time. The green line is 100% Roth conversion, which you would rarely do, but you can see that that's better than doing nothing. And what you're really going to be comparing is the insurance against the Roth conversion. So we have the math of the do nothing scenario, the math of the Roth conversion, and then of course finally we have buying insurance up front. Okay, so when we have buying insurance, you can see you need to get ledgers and you need to put this together, but you can see how powerful this truly is. Now, one of the most interesting techniques coming up will be leaving IRAs to a charitable remainder trust. Does that make sense? So we're going to do a little adjustment. We're going to come back into reality here. We're going to use a $1 million IRA, and we'll adjust these growth rates to 7% and 5%. And we're going to use an average income tax rate on CRT distributions of 24%. And we'll use an average tax rate on the IRA distributions, let's just say also of 24%. Your CRT annuity percentage, we would normally see that more in the closer to a 10% range. And then what you're also going to see is how you would take that money out over the 10-year rule. You would generally amortize that. And now we can look at really how do you come out wealth-wise. And what you're very quickly going to see when you're in this situation is you'll be able to compare, how do I leave more to my family? Do I leave more to my family with the CRT or with using the 10-year rule? Little bit of input here. You have to be able to run the CRT numbers. You'll always check those against Number Cruncher. And then you will also use, this is your CRUT as an IRA beneficiary. You can see all the distributions, how those are taxed. You're obviously going to take those out over a longer period of time because you're going to be using a 20-some year life expectancy. And then your CRAT, your charitable, so you have a unit trust here, an annuity trust here, and here you have your 10-year distributions amortized over time. If you come back to the income in summary, again, we used a 7% growth rate, 24% rate on the CRT distributions. Let's say that 10-year distribution, however, had a little bit higher rate, even if we put it up to a 28% rate. How will that affect things? And you can see how these things are really going to work over time. The critical definition here is, what is your annuity payout percentage? And what you're going to have to look at is, how much can we really take out of this each year, okay? And will that be, in this case, you have to check this last little key here, is the charitable remainder as a percentage of the amount transferred to the trust was 14%. So that means you're within the parameters of what we're allowed to do. So we've certainly covered a lot of ground here. What I want to emphasize is this is a great opportunity for you to help your clients. These tools will be very valuable in looking at what is the right way to go on a going forward basis. What is the best thing to do? So again, we've covered a lot of ground. Hopefully you've picked up some ideas on how these tools can help your clients. On behalf of Lineberg Information Services, this has been Bob Keebler discussing the IRA analyzers after the Secure Act. Thank you for spending a minute with